Hello, welcome back. Thank you for tuning in again to our second episode of Investor Intelligence. It's your podcast for all things investment, brought to you by the team at the Property Mentors and hosted by me, Phoebe Sikowski-Wallace. So in our last episode, we talked through the 3 stages of readiness, which is emotional, educational, and financial, and how each of these steps help you get the best results to invest successfully. Now, if you haven't already, go back and listen to that episode as it closely ties into what we're talking about today, which is identifying the kind of investor you are. Now, as there are so many different goals and so many different reasons as to why someone wants to invest, by extension of that, there becomes different types of investors, and not knowing this, or at least not being aware of it, can play into why investors fail a lot of the time. So with me again today is Luke Harris, who is our property investment expert, who is going to talk us through these different types of investors. Welcome back, Luke.
Thanks, Phoebe. How are you?
I'm good, thank you. Now, Luke, first of all, why does knowing what kind of investor you are help people to invest successfully?
Phoebe, I think the thing that people need to understand is that there are different types of investor profiles out there. And whenever you're trying to invest for the long term, you want to do it like the investors that are successful, don't you? You don't want to do it like the ones that fail. So understanding what type of investor you are first can help you to make the changes that you might need to make to become one of the successful investors.
Yeah, and you talk about 9 types of common investors in your book, Let's Get Real. And I want to talk through them today because I think they are great in helping people, as the book title suggests, get real with themselves and recognize where they are and where they have that room to grow. Now, bear in mind, listeners, that while these categories are obvious generalizations, there's still a very good chance that you're going to recognize parts of yourself in them. It is okay if you fit into any of these categories, as none are perfect. All the categories come with their pros and their cons, but most importantly, they all leave room for growth. So, Luke, at some point, you yourself have been one or all of these investor types at different stages of your journey, hence why you know them so well. Is that fair to say?
Absolutely. And also part of these profiles that, as you said, they're generalizations, but these have come through my career investing in the last 21 years or so and seeing my own changes and my own growth to the way I approach investing. And also friends, family, and other people that I've known over the years and sort of got a bit of an understanding on how they invest or how they see themselves as investors.
Well, who better to explain them then? Well, let's get into the first one. Talk to me about the wannabe investor.
Absolutely. The wannabe investor was me when I was a little bit younger. So the wannabe investor really, I guess as we've covered in Let's Get Real, was really designed as I guess somebody they've got an interest in investing. They love being involved in investing stuff. They go to seminars and things like that, but they're always talking about investing but never actually do it. So they seem to be a bit of an expert amongst friends and families, probably the type of person you'll see at the barbecue, talking about the property market or talking about the stock market or even Bitcoin, whatever it might be at the time. And they typically they want to invest, but they're not quite there yet. But they're very confident in talking about it.
Okay, so sometimes their talk doesn't quite match the walk. So they know a lot, but they maybe require a little bit more confidence to carry out the meaningful action.
It's confidence and also the education that goes with that. So obviously they need to get the education so that they can do it, but also they might be just the type of person that just likes talking about investing and they actually don't even intend being an investor. They're just essentially a wannabe investor. And I guess when I was a lot younger, that was me. I didn't have the money to invest, and I actually thought, I wanted to do all of these things, and I considered myself as a young kid as a bit of an expert in property. It's amazing how much I've learned in that last 25 years or so since I started exploring property, and there's always more to learn.
Yeah, fantastic. So the next one is the frugal investor. What can you tell me about the frugal investor?
Yes, well, the frugal investors, I guess somebody that's looking for a good deal. They might be trying to save money on a particular property or a particular investment, but they prefer to do it themselves rather than get advice from people that have done it before. They don't want to spend any money to get the education. They figure that they can sort of learn it all themselves. And I was very much a frugal investor at some point in my early investing years. I didn't want to spend any money on getting advice. I didn't want to spend any money on getting external consultants or getting people to help me, because as a cocky little 20 something, I assumed that I could learn it all myself and I didn't need to pay experts to help me, because I could go out there and do it all myself. And the frugal investor is very much that wants to, save a few $1,000s on getting some good advice, yet they're going to go out there and spend $500,000 on an investment. So, the numbers don't really add up when you're looking at getting advice from people that can help you to save money and make good investment decisions. People that have experienced it before and done it before. It pays to get good advice, and obviously free advice can be some of the most expensive advice that you can get.
That's a great way to put it. It's that, saving pennies but paying pounds, as you say in the book.
That's it. I don't know why we didn't use Australian currency for that, but same example there.
Targeting all kinds of audiences. So the next one is the impatient investor.
Look, I think all investors are impatient at some point, because people that I guess the impatient investor is somebody that wants to get started. They're happy just to throw money at something and hope it all works out, and they don't want to worry about all the boring education stuff and really understanding the fundamentals, or going through due diligence and really understanding their investment or how it fits in with their plan. And I guess really from that perspective, they're more interested in getting their money out there in the marketplace than making sure they've got a good investment for a good long-term, as part of a good long-term plan. So I think that's the key thing here, in that a lot of people will just rush to get their money out there, and they think that they've just got to hurry up and get in the market. They see something in the media about property prices going up and think, don't worry about all the education stuff, don't worry about all of that stuff, I just need to buy something. It's that when property prices are going up and there's a lot of media hype about property, there's like I've called it the BAN mentality. It's BAN, buy anything now mentality. Is people is just, I just need to buy something and get in the marketplace. Don't care what it is, where it is, I'll buy what I can afford. And I think that's the impatient investor to a certain extent, is that they just throw their money at the wall hoping it works. And for me, that's not really investing. That's very much gambling.
Yeah, they sound like a passionate and eager kind of investor, but they sound like they also just want the immediate outcome, as opposed to really going through the process to get to where they want to be.
The boring stuff.
That's right.
The boring stuff is actually what makes money. So, unfortunately, people that are impatient and want to just get out there and invest and get in the market thinking that everything's just going to work out, and it does for some people, but for most it doesn't. So it's all the boring stuff is where you make your money in property.
Good to know. So the next one is the cynical investor. Now, this doesn't sound great, but what does the cynical investor entail?
Look, I think the cynical investor, as the title probably says, is that, I think they're more worried about what can go wrong than what can go right. They're skeptical about everything, skeptical about interest rates going up or down, skeptical about what type of properties, what areas, what research, what due diligence. They're always worried about something, and typically it's because they don't trust themselves. They might have been reading a lot of negative media, and it's very easy, and I've felt myself doing this at times, is that you start reading negative media, stuff that's talking about bad things happening, and you get into a cycle and you read more and more of it. And because of that, you're more likely to curl up in a ball and hold on to what you've got rather than take risks and get out of your comfort zone and invest. So the cynical investor often sort of thinks that the whole world is a scam and everyone's going to rip you off. And I think people can often do that because they don't trust themselves to make good investment decisions. They've started to believe all of the negative stuff that they've been reading, and they're more worried about the bad things happening than being excited about the good things that can happen.
Yeah, and in the description in the book, I like that, on the positive side, the cynical investor tends to come with enough skepticism to think critically when paired with a curious and eager mind, and they ask lots of questions and they don't settle for mediocrity, but It sounds like they can also tend to dwell on past investments and, as you said, what can go wrong as opposed to what can go right.
Really, what it comes down to is that it's okay to be skeptical about all things related to investment. It's actually healthy. But the thing is, to get the best results, you need to balance that with not the things that can go wrong, but you need to balance it with the things that can go right. And the cynical investor is somebody that just looks at the negative side of it and doesn't balance it out with the positive side of what could happen if they make good investment decisions. And often, as I said before, is that they don't trust themselves to make good decisions, and a lot of the time they'll stay in their comfort zone and stay where they're at rather than move forward. And it's something that is difficult for people to accept, that they are a cynical investor. And moving out of that, they need to take special steps to get out of that part of their investing career.
Fantastic. Now, I really like the name of this next one. It's the I'll Try Everything at the Buffet Investor. Please explain.
Yes. Well, as was said in Let's Get Real, we're not talking about Warren Buffett. We're talking about we'll try everything at the buffet investor, where investors will go out there and they really want to try a bit of everything, right? And everyone that knows that they've been to a buffet breakfast or a buffet lunch or dinner somewhere, there's so many good things there, and you just want to try a bit of everything. And a lot of people are like that with their investing as well. And again, this all comes back down to investors not having a clear plan of what they're trying to achieve. And they'll try a little bit of everything and hope that something's going to be a silver bullet for them, and something's going to be the one thing that's going to work for them. And I think the thing with this type of investor is that they might be the type of investor that goes and does similar to myself in my 20s, goes and buys a house, does a renovation, buys an apartment, buys a development site. Buys off the plan, bought in a mining town, try a bit of everything. And what I realized through doing that was that there is no silver bullet. There is no one magic property that's going to build wealth. These type of investors will probably also go out there and dabble in a bit of Bitcoin, dabble in a bit of cryptocurrencies, shares, who knows what, but they'll try a little bit of everything and hope that something works out for them. And really behind that is no real strategy. It's more, I guess, a bit of an invest and hope strategy. If I put my money in a lot of different places, hopefully something will work out. And often behind that is, like the title says, I'll try everything at the buffet. It's not I will invest everything with clear decisions. It's more I'll try and see how it works out.
Yeah, if there's one thing we can't stress enough here, it's having a plan in place to get you to where you want. Do you think that through the process of trying everything, it means that they can tend to waste money and they can tend to leave little capital left to invest in what actually matters to them?
Well, that's exactly right. I think the thing is that not only are you spending money as opposed to investing money, you're losing time. And with investment, it does take time. For long-term sustainable wealth, it takes time to build that up. And nothing that we teach is about a get-rich-quick scheme or making fast money, because that does carry higher risk, and it isn't suitable for most people. So if you're going out there and investing in things that aren't matching up with your long-term plan, then sure, you might make a little bit of money, you might lose some money, but you are losing time. That's one thing that you can't get back. You can always make more money, but you can't get the time back. So if you're making your investment decisions based on your long-term plan, then you can very easily make the very best investment decision at the time rather than wasting that decision on the wrong investment. Because getting in and out of an investment, especially with property, you've got stamp duty and selling costs and the capital gains tax and all sorts of things to consider buying and selling property. And so if you're buying the wrong one, it can be a very, very expensive mistake.
Yeah, that's a great point to make. And it sounds like by not having that clear plan, it can actually lead to this next type of investor, which is the burnt out investor. Now, burnt out surely being a term that we're all aware of now, especially after the last 2 years. But talk to me about this kind of investor. Why are they burnt out?
Yes, the burnt out investor. Look, a story that somebody told me many years ago was that we were talking about the Melbourne market, and he was from Brisbane, and really told me that he would never invest in Melbourne because he lost money there once. And this was maybe 10 or 15 years ago now. And if we look at what the Melbourne market's done since then, I bet he's kicking himself
Right.
that he didn't buy in Melbourne 10 or 15 years ago when we had that conversation. But I guess a lot of the time, the burnt investor is somebody that I guess something went wrong in the past, or a friend or family member or someone that they know invested in a particular asset or a particular area, and really they haven't moved forward from that. They haven't moved on. They've held on to that thing that happened in the past. And we all know somebody like this. It's not always related to investing, but somebody that we all know that just won't let go of something that happened 20 years ago.
Oh, yeah.
And it's no different with investing. And I think the key thing to understand about this type of investor is that really all investors make their own decisions. And at some point, you've got to own the decisions that you make. You've got to be responsible for the decisions that you make. In my 21 years of investing in property, surprisingly, no one has ever come to me and held a gun to my head and forced me to sign a contract on a property. It's never happened. And so, based on that, most investors need to understand the fact that you've made these decisions. So, if you've bought in an area that didn't grow, if you've bought the wrong property, or if you've bought a property, from an agent and believed everything that they told you without doing any research, then you need to own that decision and accept the fact that you made that decision, you invested your money, and that you are ultimately responsible for the results from that. And on the flip side, when you make good decisions, you make money from your investing, you make good decisions, you get to celebrate the fact that you made those decisions yourself. But you can't have all of the good and not accept any of the bad. So you've got to understand that that if you did have a bad investment outcome, that you're ultimately responsible for that. And the thing for me in particular is I take ownership of the investment decisions that I make. If something doesn't go to plan, then we've got to adapt and adjust the plan to suit. And I think a lot of people that have been burnt in the past, they could have been sold a property at a seminar. I've been to a lot of seminars when I was in my younger years with people jumping on the chairs and high-fiving each other and loud music and all that sort of stuff to get people excited. And I know they were selling apartments on the Gold Coast and all sorts of things many years ago. And I think a lot of people have lost money in property, and they've lost money to spruikers and sharks and cowboys, as we talk about in Let's Get Real. And I understand why people would get burnt, but at the end of the day, nobody held a gun to their head. So the issue with not moving forward with that is that your investment results are not going to change unless you can accept the fact that what's happened in the past has happened and you move on from that. If you want to hang on to that experience for the rest of your life, it's probably not going to change your investment results. And because of that, probably not going to move forward with your financial results either.
That's right. Learn from the mistakes and put that dwelling energy into maybe creating a better strategy for the future.
Absolutely.
If you wanted to get fit or start a fitness program, you wouldn't run a marathon if you hadn't yet mastered jogging. You also wouldn't begin weight training by lifting 30-kilo dumbbells. There are, of course, multiple ways to keep fit through a variety of sports and exercise programs. However, there is a process to getting into shape and achieving peak performance. It's the same when it comes to investing in property. You need to start by doing some self-assessment of where you are now to where you'd like to be. This would be your fitness test. You have to find your team of experts who will help you along the way. These would be your trainers. And learn how other people invest, including the mistakes they've made. Only then can you start to look at how you will achieve your property investing goals. Property Fit assists you with all of this. It's the latest book from experienced property investor, entrepreneur, and founder and CEO of the Property Mentors, Luke Harris. It's the book that will guide you through the groundwork you need to cover before you start investing, exploring all the ways to invest in property by helping you find a strategy that will lead to the ultimate goal of financial freedom. Property Fit is your easy-to-read, practical book including mentor tips and mindset insights, as well as proven strategies that seasoned investors or those just starting out in property will find invaluable. Visit propertyfitbook.com.au to purchase your copy and get your property portfolio in shape for financial freedom. So the next one is the been there, done that investor.
Oh yes, they've been there, done that investor. I felt like I was this person, this guy for a little while, and I think especially in my 20s when I was a little bit cocky. I'm a little bit different now, but I think a lot of people that have sort of been there, done that, they've had some successes in the past, whether they're big successes or small ones. And I guess to a certain extent, they know what they're doing, and they're a little bit too proud to ask for help. And I think knowing that they've had some wins in the past, or that what they've done in the past has worked, they feel that they don't need to learn anymore. They already understand everything and they already know it. And I guess being there, done that, sort of they're the type of person that will come up to me and go, well, I would never invest in Melbourne because of this, or I'd never invest in Perth because of this. And using some information that might be relevant, but not looking at the big picture and taking a narrow view on, what's a good investment and what's not a good investment. So I think a lot of the been there, done that investor, I guess they're very proud of what they've done. They've had some good results, and whether that be in any investing, it doesn't have to be in property, but whatever they've done, they're quite comfortable that they're making good decisions and they don't need or want any help, and that's okay. If people are okay with hey, I've been there, I've done that, I know what I'm doing, and I don't need any help, that's okay. But we've found over the years the most successful investors are the ones that are always open to getting help. They're always open to new information, always open to learning. If you ever get to the point where you think that you know it all, well, your results are probably going to peter out at some level. They're going to taper off and you're not going to continue growing. There's always new information and there's always new data and always things to learn. And I guess the day you stop learning is the day you die, right? As far as I'm concerned.
That's right. There is no way that there is anyone out there who knows absolutely everything there is to know about investing. Even the best, or the people who have been investing the longest, will always have room to grow, which is a great segue into the next two investors. And this is kind of where everyone would like to be, as this is where we see the most successful outcomes. So the next is the aha investor. Aha to mean when someone has an aha moment.
Yeah, look, the aha investor really is somebody that has been through the previous steps where they've had a light bulb moment where they understand that they can't do it all on their own, and they want to go through a process to get help with their investing. They understand that they're going to have to take some responsibility for their investing, but also that they're going to need an expert team of people around them. They realise that investing does carry some risk. They realise that things are going to take some time, and that little light bulb moment often is a big thing for people where they really get an understanding of, the big picture of investing. I think the key thing with the aha investor is when they get that big picture understanding of their investing, and they know that it's going to take some time, there's going to be some risk attached to it, and that they're not going to be a multimillionaire overnight. And I think the aha investor, when they get to that point, it's a breakthrough moment for a lot of people that have been through some of the other profiles. And again, people will have little mini moments of aha investor along the way as well with some particular part. They might have a mini aha moment along the way where they realise that they are not going to become an expert mortgage broker. And then they accept that along the way. They may be a mini aha moment along the way with their accountant and other steps that they'll go through. But when they get that overall aha moment with the big light globe goes off, that's when they really make that shift and become that aha investor. And it's a big thing for people to make that realization.
Yeah, it definitely sounds like you can't get to being a aha investor without being one of the previous ones we've spoken about. And I guess that's a very comforting thought because, if you don't like the sound of one of the previous ones, but you feel like you are sitting there, the chances of you becoming an aha investor are much higher, which is very good to know.
It's being aware of these first, and this is the reason why we've spelled these out and the reason we're talking about them today is for people to get an understanding. When you're in your day-to-day, it's all in your head. When you're in your day-to-day investing and you're out there doing what you do, it's all in your head. So you don't know what type of investor you are until somebody holds a mirror up and says, you know what, you're probably this person. Okay, or you might be a little bit of this person and a little bit of this person. But until you're actually consciously aware of that, you can't change it. You can't change what you don't understand. So if you understand that you might be one of these and you prefer to be this one, well, once you know that and acknowledge where you're at, then you can take steps to change that. Then you can take steps to work with a mentor or someone that's been there before to help you to get out of your current investor type or your investor profile and move into that AHA investor type. So it really is important just to be aware of it. Again, none of these profiles are, they are very generic. They're not designed to make anybody feel bad. But at the end of the day, if you're aware of this, then of course, then those steps can be taken.
That's right. Now, the last one is the armchair investor, which I think everyone would like to be the armchair investor, but describe that to me. What does that look like?
The armchair investor really focuses on, like I mentioned previously, is the big picture. They're really focused on the big picture. They understand that, they might work in their profession and they're very good at their profession. They also understand that they're not necessarily going to have time or the energy or the effort to become an expert property investor. Now, what that means is that they will go out there and like I've mentioned previously with the AHA investor, they've got a team of experts that they lean on. They've got a team of experts that they rely on. They rely on their lawyers, accountants, solicitors, mortgage brokers, and all of those people that can help them. They know that they can't do everything themselves. They're probably very focused on their careers, and that's where their attention should be, rather than trying to focus on their career and also become an expert in property, because that can take a very long time. They're focused on value, not cost. And that's a very key point, because a lot of people will look at, if I'm going to spend $1,000 on an accountant, what am I going to get out of that? Rather than saying, that's $1,000, why would I spend $1,000 on an accountant? They're saying, well, for $1,000, how am I going to get the results out of that to justify the $1,000? These are the types of investors that understand that they're not going to go and try and negotiate with their accountant. Certainly not something I recommend. You want a good accountant, you pay them. You certainly don't want to negotiate on your accountant's fees. They're a professional, they charge for their time, and you need to make sure that you're using the right people and you value the advice, which can save you tens of thousands, if not hundreds of thousands of dollars, by setting up the right entities and looking after your tax. So what that armchair investor really means is that they have a network of people that they work with to help them build wealth, but they also still manage their career and get a good balance between their work life and family life and also their investing life, so that they don't have to go and work 40 or 50 hours a week and then spend another 30 or 40 hours a week in their spare time to learn how to become a good investor, because they don't trust themselves to make good decisions with their advisors. So what I mean by that is, if you don't need to know everything about finance, you need to know enough about finance. You don't need to know everything about accounting and asset protection. You need to know enough to be able to have a good conversation with your accountant. You don't need to know everything about self-managed super funds and insurances, but you need to know enough to be able to talk to your financial planner about it. So all of these things really get factored into the long-term decisions that you make, and being able to have those conversations with those advisors and rely on that advice is very helpful. But you don't need to be an expert in each of those areas. But I know enough to be able to ask good questions, and investing as an armchair investor means that you're asking good questions and you're leaning on their experience to help you to get the best results.
Yeah, I think that's a great example of, no matter how experienced you get with your investing or how long you've been doing it for, having that team behind you, no matter how experienced you are, and knowing when to delegate the specialized tasks to those dedicated professionals is always going to bring you the best outcomes.
Absolutely.
So they are the 9 types of investors. Now, there's obviously numerous variations of these investor types, but you can clearly see that there are only 2 groups that succeed at a sustainably high level, which is the AHA investor and the armchair investor. But remember, if you do identify with any of the other types, that is okay. It just means that there's room for you to grow if you want to pick up your property game.
The last thing I'll probably say on this is that there are combinations of these investors, like we've said before, and you might be one or two of these investors for a short space of time. The key thing to note with your investing is that you've got 2 things that you need to focus on. Is you've got your emotional readiness and your educational readiness. We always talk about your financial readiness as the 3rd component, but in this particular example, and talking about why most investors fail, is because they don't have a good understanding of their emotional readiness and they don't have a good understanding of their educational readiness. So through all of these different profiles that we've just listed, there's different parts of that are relating to your emotional readiness and different parts that are relating to your educational readiness. A lot of the emotional readiness comes from the educational readiness. So the more education you get about your investing, the more you learn and the more you understand, the more conversations with your accountant, your mortgage broker, your property mentor, the more your education will increase. Now, as your education increases, that'll increase your confidence. And as your confidence increases over time, it's not going to happen overnight, but over time, your confidence increases overall, and that's going to help with your emotional readiness to go out there and invest. And with that emotional readiness, you're able to go out there and make well-informed, good decisions that can help you on your long-term plan.
Yeah, they really do go hand in hand with one another. And if you would like to refresh your memory on the 3 types of readiness, that was what last week's episode covered in depth. So please go back and listen to that if you haven't already, because all of what we've covered today will make a hell of a lot more sense. If you want to read more or familiarise yourself with the types of investors we've touched on today, you can read them in Luke's first book, Let's Get Real. If you would like to know any more about the Property Mentors, you can check out our website and visit our blog, which is linked in our show notes, along with all of our socials. Luke's new book, Property Fit, is also now available for purchase, which you can also find at the website propertyfitbook.com.au. Make sure to stay tuned for next week's episode, as we'll be talking about what your roadmap to success looks like. Until then, thanks again for listening, and Luke, I'll see you next week.
Thanks, Phoebe. Look forward to it. See you then.